We suppose we are back live about 3 minutes late, which is typically what a startup life cycle is about. You're always learning. This is our first time as well. So probably next time we'll be 5 minutes early than being 3 minutes late. Welcome to the first masterclass on cap table management by startup movers. What was supposed to be an internal training session for our team apparently is now turning out to be something that we wanted to share with the whole ecosystem. We realized that it's not just a technical jargon that a technical or a professional team has to go through. We now realize that even the basics of it, if it has to go out to the ecosystem, it will add value. So in that series, we've taken an initiative to go back to the ecosystem and share our stories of the past 15 years, starting from the basic. It's a 3-episode masterclass. This is the first episode where we'll be covering basics. My name is 𝗖𝗪 𝗧𝗯𝗹𝗲. I'm a chartered accountant. I've extensively worked within the Indian startup ecosystem for the last 15 years as a general practitioner, working around specialists. And with me, I have two specialists today. I have with me 𝗖𝗽 𝗧𝗯𝗹𝗲 and Nitin Agarwal. Akash, maybe you can tell a little bit more about yourself.
So I started my journey as an intern here only, and it's been 10 years working in the startup ecosystem dedicatedly, serving to the founders, helping them, guiding them on to their day-to-day compliance of funding-oriented valuation and diligence advisory.
What about you, Nitin?
Hi, Sumit. Thanks for having me here. Nitin, and I'm a chartered accountant, same profession. I've been working with startups on valuation front. I help startups in financial modeling, understanding their, funding requirements, etc. And it's been a long time. So I've been in this profession for last 12 years now, post qualification, including if you include my pre-qualification experience, to be around 15, 16 years now. So again, good to be here.
Perfect. So we'll start off this conversation keeping it very, very basic. By the way, the kind of people who've shown interest in this masterclass, was surprised that a lot of those folks who are already within this niche were also interested to know what's going on. But just to keep everybody ready for what's lying ahead, first episode, we are covering a lot of basics. And we'll go into a technical of, say, preemptive or SHA terms and all in our episode 2, ESOPs in episode 3. But today it's just about, let's start off with founders journey, right? We are at day 0, just thinking about starting up, somebody who's leaving their job, somebody coming out fresh out of college. So my first question to set up the framework would be, Akash, to you, that as a founder, whether I'm coming from an experienced background or whether I'm a fresh starting up from a college or even a college dropout, we've seen the questions around what kind of entity we should incorporate, especially in terms of fundraise. I have fundraise plans. I don't have fundraise plans. So what is your view? What has been your experience when we are taking a decision around choice of business entity? What options do we have?
Okay. So in the Indian ecosystem framework, there are two kind of structure. One is, say, for profit. One is, say, not for profit. So in the profit, there are a lot of entities which we can have in India, like the proprietorship firm, partnership firm, private limited, LLP, OPC. In the non-profit segment, we have say trust and the society, right? So all of these entities can be formed based upon the client requirement, based upon the founder's requirement. Most particularly talking about when I talk to the founder, so it's been like, so my first question to the founder is, what is your plan? Either you're looking for some fundraise or not, right? So the straightforward answer is that if you are looking for fundraise, go for the private limited. Private limited is why private limited is more important for a founder to have the fundraise is private limited is been more favorable for the investors. It has been more regulated, where the investor is very much inclined, right? Their money, they feel in the private limited, the money is safe. Since it has been regulated, it has been most clear structure in India to do the business, right? Again, a comparison to the other form of businesses, since it is more regulated, it is highly expensive also in terms of compliances. So yeah.
Any thoughts, Nitin, you would like to add?
Primarily it's about business model itself.
Yeah.
So as Akash pointed out, if somebody is looking for fundraise, they then need to allocate certain ownership of their business to some other party. Now, proprietorship concern is out of window,
Yeah.
definitely. There are certain issues with partnership firms, LLPs, which make them, not suitable for, startups, especially the ESOP point. Let's say if you want to have some ESOPs, that is, employee share in your cap table, it is not possible in proprietorship concern or partnership firm. And that's why you need to have at least a private limited company to begin with.
Interesting. You used the word cap table already in this. So that's where I think, to summarize, in terms of how much fractional ownership you want to give to your business, if it's more, then you have to have private limited as structure. And I believe one add-on point from my side would be the hybrid structures that are now popping up, given the ESG and the climate tech side, where people want to work on the impact side yet be working for profit. So we've seen where both entities are getting incorporated together, a framework being created. But moving forward with it, you mentioned the word cap table. So what is share capital? What is cap table? Ash, maybe you can just throw in some basics of cap table before we start. What is a cap table for a private limited company?
Sure. So cap table is basically the short form of the capital structure table in a private limited structure, where the shareholders' ownership is being shown in a tabular form, where each shareholder, how much he's holding, what is the percentage, how much is the ESOPs, right? So cap table basically a whole capital structure of a company, where each shareholder, how much percentage they are holding, how much shares they are holding, is to be shown in the cap table. So it is the basic definition of a cap table.
Anything you would like to add?
No, I think he has covered pretty much everything in the cap table. The thing is, as you grow, you begin with, let's say, 2-member team, and then you will add more employees, you will add more investors to your ownership structure. Now, as you mentioned earlier, there has to be some kind of fractional ownership possibility. Now, when you summarize the summary, who owns the business and how much, that is basically what cap table is. Now, cap table, leads to a question: what is share then? Share simply is, basically you're dividing the whole ownership into fractions, and every fraction is known as a share. That, it's a kind of convenient way of transferring and owning a company. And this is what cap table and capital table actually is.
Interesting. So before we proceed ahead, maybe people could have joined from different parts, so it would be better. So it's a request, if you have joined us on LinkedIn, please drop in the location where you are joining from. It will help us organize this better. And please throw in your questions in the comment box. We'll be happy to keep it as a mutual learning curve rather than just a masterclass between us. So Nitin, to go ahead, यार आपने बहुत राउंड क्लोजर्स के वैल्यूएशंस किए होंगे और कैप टेबल्स अर्ली स्टेज देखे होंगे. So tell us that once you look at that cap table, there would be 2 co-founders, 3 co-founders, 1 co-founder. How do they decide their initial ownership, right? Is there any thumb rule, any equation, or is it just gut feel? What is followed in this ecosystem?
It's a very simple question as well as a difficult one.
Yeah.
See, first thing is about the business. The number of co-founder itself is a critical question. So based on the nature of business, you may decide whether you need only 1 co-founder. That means a team of 2 or 3 or 4. Now beyond 4, it's a mess.
Absolutely.
Right. Second question comes, who brings what to the table? That is very critical. Now, just to give you, I like throwing numbers. So I'm just throwing a number, here. In 40% of the startups, the cap table, has equal ownership for initial co-founders, where 2 or 3 co-founders are involved. That seems like a logical way of looking at it, but then again, there could be questions around who is bringing what. Is there a co-founder who is bringing some kind of IPR? Is there a co-founder who is bringing in some marketing capabilities, which is over and above what other co-founders are bringing? So there is no thumb rule as such, but then you cannot have a structure where one co-founder is having 90% share and another is having only 10%. Then the question arises, why 10%? Is he actually a co-founder? You're not actually respecting the other guy when you are giving only 10% of the business. Initially, people may agree on anything.
Yeah.
And as the business grows, business changes, the roles and responsibilities evolve. And at that point of time, this question, it may haunt you, right? So one thing is, you may start with any, structure, any kind of breakup into of the ownership, but be flexible and recognize other people's efforts also. So be flexible enough to change those things later on.
interesting you use another word that, so I'm catching words in both of your thoughts. You said flexibility. One reason that I always go out and speak with the ecosystem in terms of startup failures, it's never been funding, but it's always starts with co-founder conflicts. So maybe Kash, you can throw light on how co-founder conflicts on, say, percentage ownership can better be managed upfront, so that later on when startups are growing, in terms of cap table management also, what are those documents? How can it be
Yeah.
managed? Yeah.
So usually, what I have seen in my 10 years of experience is usually founders comes, they create the company, they decide the ownership orally, right? And then they basically don't follows that what needs to be structured, what will be the role. They don't define all of those things because either it is the company is being formed by some friends, by some family, or maybe spouses have created their say the company, right? So my suggestion to the founders is basically that if you are forming the company, the co-founder agreement is also important. The reason being that you will have to define your roles, say the responsibilities, duty, that what is going to be X role, what is going to be the Y role, right? And then based upon that, the percentage should be decided between the founders. And then once this full-fledged agreement is in picture, right, then it it helps the founders in the long run. So when the terms and the roles have already been decided and already been articulated in a form of agreement, right, then there is the chances of having a dispute between the co-founder on all of these terms, which we have seen usually, right, are very less, are very minimal. So, yeah.
Interesting. So, and a question which we might not have prepared, but it popped up in my mind. So, before we go into, so now we've incorporated the company. So, let's say we are now in a storytelling mode. We took an example of co-founders who started fresh. They now have a company. They have some percentage ownership. Cap table is started getting building up. They've done this co-founders agreement. What is important? Bootstrapping or fundraising? How do you take a call as a founder? What should you be thinking? At what is the right time to raise funds? Should you raise early? Should you raise later? What are those few nuances some founders would have given you in terms of right timing of a fundraise?
So, I mean, here the bottom line is the most expensive thing is equity. Don't dilute your equity too early if you can, I mean, defer that thing. That's a thumb rule. I mean, now how to raise funds and when to raise funds, how much to raise, all these questions, again, there are variables and they are function of other variables. One of the variable would be the nature of business itself again, you know. If you think that you are a first mover in the market and you want to create a niche there by kind of or adopting a blitzkrieg marketing and be the first in the market, so you would need funds in the initial stage itself. Second, they're the founders who are just, I mean, they have just got out of college, they don't have anything. So as Prem Chopra sometimes said, nanga nahega kya nichodega kya type. You don't have any option. You have to raise funds.
Yeah.
But if you're an experienced professional, you have already worked in the industry for 10 years, you have some corpus to take care of personal commitments, then why not? So you defer your funding round, you build your MVP, from your own funds, and then you go to the market with a higher valuation.
Yeah.
So these are I mean variable questions. No, I mean single standard size can fit all.
Yeah, I think in few of my use cases, the problem had been that we had recommended that, of course, like you said, the cost of equity is the highest, right? It's always said that how will we leverage debt and all. But there are grants, MSME loans, startup loans that are available, which are keeping your cost of equity down. There are two problem statements. One, people are not aware. Two, the gestation period of raising those grants and loans are so high that 3 months, 6 months to get that money. That time value of money then supersedes that cost. So if somehow the ecosystem can bring these initial grants or these initial MSME or startup loans, and I would see the cap table movement will start at a very late stage.
Yeah, I think you highlighted the fact, and I think even Government of India understands this.
Yeah.
So 𝗖𝗽 has started this, fund of funds kind of thing, where they put money into different funds and they encourage these funds to put money on their behalf.
Mhm.
So I mean, late stage funding is still happening. There are a lot of players, but what happens with those smaller ones? They just need like 30 lakh, 40 lakh, 50 lakh check.
Yeah.
Right. So that ecosystem, is still evolving. It will take some time, but I think we would be there in some time.
Perfect.
So adding to this, likely you mentioned that there are a lot of incubators,
Yeah.
and the founders should look forward to this. So yes, we have been seeing this, that the government of India has been making a lot of noise, ease of doing business, fund of funds, SIDBI, and all of those things. The problem which I've seen with the founders is how to get the entry into it. So that is the most difficult path for anyone, that how to get an entry for getting these access to these funds, right? So yeah, we have seen the incubators which has been granted the funds by the government of India, right? But how to get an entry to the incubator, right? What will be the evaluation for those incubator? What all are the parameters? That is where the founder are still struggling, and that is the question which needs to be solved by this Indian startup ecosystem.
Just going a little off track, just sharing a personal thought. So it's a mixed emotion. So, say an example, we get to attend Abhivakti in IIT Kanpur region, and I am always blown away. They're one of the OGs in the incubation, right? The kind of startups they're incubating, the quality of startups. There are more. But then at the other end, there are founders coming to us saying, oh, we applied for a grant and it's been 6 months, DD has already happened, fund is not getting released. So there are kind of mixed emotions right now that are existing. But let's move on with the cap table. So we'll divide it into two parts. One, somebody who's got a grant, so there is no movement on cap table. They have the money and still the cap equity is secured. But let's talk about someone who's in need of funds. How will that funding cycle look like, right? Can you run us through various funding stages, or how will you define various funding stages for a startup? Just run us through those.
Right. I mean, the question would be, I have seen some newbies, coming in the market where they say, just arrange 10 crores and we will build a profitable business. So they're asking for 10 crores in the first instance. And they don't have any, workable product as of yet. The question is, would investors give you 10 crore in one single tranche?
Yeah.
The answer is no. Venture itself means that you are doing something riskier. That's why banks are not there. You're going to some players who have to put own money into your system, your company. So what they will do, they will divide this 10 CR into different stages. They will set some milestones for you, or you can set those milestones for yourself also. Instead of asking 10 CR, you will say, okay, just give me 50 lakhs and I will build the app first. Or give me 1 CR, I will have the app ready, plus I would have some, POCs, proof of concepts running already. Once you reach there, then you have already proven your metal. And then they would be willing to bet on you further. So this is how ecosystem works. They don't give you money in single tranche. They divide the money into, different milestones. And once you reach there, they will be ready for the next one. And every time you are reaching there, it's a win-win situation. On one hand, investors are de-risking their bets. They're not putting everything in single tranche. So if the venture fails in the first stage itself, only 50 lakh is lost, right? So this is one thing. From an investor side, I'm thinking from a founder side as well.
Yeah.
If you are raising funds in different tranches, then you will eventually dilute less. So you will get 50 lakhs at a lower valuation, but next 9.5 CR, you will get a higher valuation. So your dilution would happen at a lower rate. So this is how funding rounds works.
Yeah. So you use another jargon, dilution. So let's continue the journey. As a first person who's raising a first round, 50% ownership, 2 co-founders, no grants. Now we are raising our first round. First is somebody said dilution, and he said, what is dilution? And then what should be the right dilution and at what stage, and how do you define that stage? What when people say pre-seed, seed, what does that actually mean? And in terms of your experience and in terms of sector agnostic experience that you have, what will be typical average dilutions that you will say these are good brackets, but if you go beyond, you should have substantial reasons?
Right. The question that you have asked is layered question.
Yeah.
There are like 5 parts to it.
There are 5 parts to one chemistry. Yeah.
Right. So let me begin with, understanding the basics of dilutions.
Yeah.
Think of dilution as a pizza. Now you have a regular one, then a medium one, and the large one. Right. So now you're sitting with a regular one. only 3 co-founders are there, so you get 1/3 of this this whole size.
Yeah.
Now, when you get some money, you would be able to convert this regular pizza into bigger one, right? But it would take some money, and those guys who are going to put some money are going to own some percentage of your business. So let's say you raise 50 lakhs for 10%. It means they will give you 50 lakh rupees in your business, and they will take 10% ownership of the business.
1/10 of my pizza.
Exactly. So
Yeah.
1/10. But the idea is, so your pizza would be like those co-founders are left with only 90%. That 90%, instead of 100%, now it's 90%. That is what is known as dilution.
Mhm.
Now, to a layman, it may look like you are losing something, but the idea is with that 50 lakhs, you would be able to convert this regular one into a medium one.
Yeah.
Then that 10% would be lesser than what it was earlier, and similarly, your 90% would be higher than what it was earlier.
Perfect.
Yeah.
So I need to make my small size pizza into the largest one.
Yeah.
By sharing the least of the pizza
Exactly.
pie that's possible.
Exactly. And the idea is, focus more on increasing the size of pizza itself.
Yeah.
Because 100% of zero is still zero. You don't want a cupcake.
Yeah.
You want a 3-tier 10-kilogram cake where everyone can have their piece of cake.
Nice example, I would say. That makes it very simple. Which was the next question, right? You explained dilution. Now, next question was on what is the right percentage. So today I'm raising the first round, right? I've seen folks doing 50%. Akash, maybe that you will be able to answer that better, because especially in early stages, we have seen people giving 50% of their company to somebody who's investing, say, 1 crore even.
Yeah.
And then the second reason comes up. We already highlighted co-founder conflicts in previous questions. The second question is around investor conflicts in cap table, and how can we prevent it, what goes wrong, and how do you manage it through mathematical equations, right? So maybe as an example, an early stage round, how much should one dilute? What are the basics there?
Sure. Also, before answering it, I will go to your previous question where you talk about that when you are getting grant that your cap table doesn't move, right?
Mhm.
So no, it's not correct. Your cap table also moving, right? Because government is also not giving you the grant for free.
Mhm.
It's coming from the incubator. Incubator are charging you, say, a 3% equity, the 5% equity, which is going as an advisory equity or say the founder's equity to them,
Mhm.
right? So your cap table is still moving.
Mhm.
So don't take it like the grant is grant and you will just take it and go away. No,
Mhm.
it's not like this. So government has also safeguard their interest that the money which is for a purpose, right, should be used for that purpose only and should not be misused by the founders. So that is one point. Talking to the another question, right, where say the percentage of say in the pre-seed round or say the seed round is to be decided. So what we have seen generally, people do the basics, say friends and family round or say the angel round, right? So it's a very risky stage where the investor is putting the money. The product is not there, only the idea is there, or the team is there, right? So everyone is taking a bet on the founders or the team or the idea, right? So nothing is there, everything is in air, right? So uh, so what we have seen is a round happening at a pre-seed or seed stages of say between 15 say 50 lakhs to 1 cr, between in this range, and the dilution of say approximately 8 to 10% and not beyond that. If someone is diluting say 50% of or 40%, right, that assume that this is not a startup for you.
Mhm.
You have already been employed by someone else who have taken the majority stake in your ideation stage itself, right? So how will you grow? The founder should more focus on saving the equity in the very early stage. They should not dilute in terms of percentage, the higher percentage.
Mhm.
And someone who has taken the 50% equity, assume your startup is gone and you are not going.
You're dead the day you raise funds.
Yes.
Yeah.
Yes.
Very interesting. So moving on from here, what we've heard is growth capital sometimes and risk capital, right? So there are stages of organization where we say it's a risk capital. Of course, Later stage is also risk, but some point of time people start calling it growth capital. So what is Series A? What is growth capital? I mean, when does it come into picture?
So like every word, these series are also made up. I mean, technically every word is made up, but seed round, Series A, pre-Series A, Series B, these are all names given by investor community. I mean, just to make everything simpler for everyone. It simply means, what happens when you are just starting out? There is nothing, concrete as of today. So you are going to create some product or a roadmap. Then you are going to, have some few, free customers, some running POCs. Then you will prove that customer, this product is workable. Once this is done, then you will go to the market. Then at every stage, your expense nature would change. Initially, you're hiring team for development. Once that development is done, then you're hiring the sales team, the marketing team, and they are going in the market, trying to get the business. And then once you prove that this is a workable solution and there is a product market fit for this product, then you go for a expansion. So this worked in Delhi, it should work in Mumbai. It should also work in Bangalore. So let's expand in all metros and tier 1 cities. So this is what is different. There's a differentiation between these rounds. Seed is basically product. Your Series A is when you are going to the market, and from Series B onward, you are growing and you are, either geographically or vertically in terms of product life cycle, value chain, etc., etc. So
typically, I've heard people saying that in this life cycle, if you are raising multiple rounds starting from pre-seed till about Series A, if you are holding more than 50% of a company, you are still in control, and that's what the target should be. That of course you should have as much equity as you want, but you have to create a balance.
Right.
If by Series A, Series B, you are still owning more than 50%, it is supposed to be a good, healthy ownership in the company. You have a ownership stake, majority stake. Now, moving on from there, so now there is a two-founder company that we've talked about. They've applied for grant, didn't get it. Then they raised initial round, say, we're saying 50 lakhs at about 10%. So like cap table has started shaping up. But in terms of who gets what, we've heard founders having some different rights or different instruments, and investors stressing on different instruments. So first of all, Akash, what are those instruments? And if you can run us through what are the most common instruments that are used in order to depict the ownership of the company on a cap table for various stakeholders.
So there are a lot of instruments which can be used to raise the capital investment in the company. Yes, they are debt instrument also. So the common instrument are, say, equities, again the common stock which is being holding by the founder also. The investor usually preferred either the preferred stock or the debentures, the convertible debentures, if they are making a say the investment into the capital, right? If they are making a debt capital, then it's a different story. You can go anywhere to raise debt. So talking about the capital instrument, they are equity, they are CCPs, they are debentures which are going to be converted into equity portion. So the most so why the investor are not inclined? So investors are usually not inclined for the equity. They are either inclined to the preference shares or they are inclined to the debentures. What is the reason? So the reason is the preference shares is basically giving the preference over the founder security. So as and when the liquidation, or say there is some liquidation event, right? So again, I'm using a technical term, the liquidation event. So liquidation event talk about, say, IPO or some strategic sale of the company or some exit for the investors. So the preference shares or the debentures give a preference over the founder security. So that's where the investors usually prefer the preference shares or the debentures. Why founder should, since it is giving preference the investor to sit on the founder's head, right? Or say sit on the founder's above the founder, right? Why founder should consider about it? The reason is that in the early stages, or say in all the investment rounds, right? Whatever you are raising, the founder should more focus about the voting rights. So while giving the say preference shares or the debentures, so they are not diluting the voting rights. Again, there are some agreements or there are some arrangement which can happen between the parties where the investor can also focus on voting rights also, right? So then in that case, they also ask the division, or say the combination of, say, the preference shares and the equity also.
Understood.
Yeah.
So you talked about preference here. So my question here is, does the cap table, we've been talking about cap table will never tell us about the differential voting rights, or how is one class of share different from others. So what are the documents which has to be looked around along with the cap table to understand, oh, it is not just the numbers, or there are more to it. So what should I combine it with?
So definitely, if you are reading a cap table, I'm sure either you have the co-founder agreement, if you are reading it at the co-founder stage. If you are reading at a fundraise, then you must be having the investment agreement, or it also called SHA, SSA, SSHA, whatever the name you can call it for. iSafe, say the CN agreement. All of these are just the substitute name of each other of the investment agreement. So whenever you are reading a cap table, you will need to look at the agreements also, because based upon that agreement, the cap table is being created.
Interesting.
Yeah.
So Nitin, in terms of valuations, does these differential voting rights or reserve matters, or all of these jargons that are in a definitive agreement per se, or is it like valuation just works on cap table, we have got nothing to do with what is written in your SHAs?
Not exactly. So valuation has got, two things to consider. One is the qualitative factors, like you mentioned about voting rights.
Yeah.
You can't actually discount voting rights into valuation.
Yeah.
But let me, give you some, background of valuation part. In the initial stage, valuations are not based on any mathematical formula. Valuations are just a function of what is your raising, what is your ask, and how much you are willing to dilute. As simple as that. There is no mathematics involved in that. So you say that, to reach this MVP level, you need, say, 50 lakh rupees. And at max, you are willing to dilute, say, 10%. Investor would ask you 50 lakh, why you need? So you will give the breakup of that 50 lakh. These many developers, office space, trial run, testing charges, etc., etc. And second would be how much you are willing to dilute. So you would say 10%. Investor would ask for a higher number. And finally, they will settle, this discussion. So once you have this valuation number, then as a valuer, we just need to justify that number in the initial stage, I'm saying. Later on, it will become, this valuation number will be derived through your operations, your operational matrices, how you're growing month on month, quarter on quarter, what the competition is doing, what the market is doing. Everything will come into picture. But as far as rights are concerned, only quantitative factors would be considered in that. Like, for example, liquidation preference has some bearing on valuation.
Oh, is it? Okay.
Yeah.
How about conversion ratios and all?
Conversion ratio is again a drive number. You have the valuation with you, and based on that, you drive your conversion ratio. Right. So again, based on what Akash said, why investors are putting money into CCPS, that is compulsory convertible preference shares, or CCDs, is basically the liquidation preference. Think of it like, let's say company goes bust, and finally someone is able to realize 1 CR out of this company. So the question is, let's say I'm distributing this 1 CR, and then people are there standing in a queue, waiting for their line, their turn. So who gets to stand in front of you? That is what liquidation preference is. In this queue, at the last is equity shares,
which is the co-founder.
So, and then in the first, there would be CCPS, CCDs. So there's a line. Try and understand this thing. So if these guys are paid, then only you will get paid.
Right.
If their claim is not satisfied, then founders will not get anything. So that's why they don't go for equity. Otherwise, investors will also stand with the founders in the same stage.
Awesome example.
So that's the reason.
I'm getting so excited to move towards the technicals that now I'm realizing we have to come and take a step back. We also have our team sitting here who will definitely have a few questions to ask later. I need one help. I will need to check one question. So if somebody can put in the LinkedIn live in front of us with questions. So we'll move on from here. Let's continue with the same example. 2 co-founders, 50% each. They went out in the market, and I am investing 50 lakh rupees, and I asked for 50%, but then Akash was their advisor. So finally they agreed on 15%. They got saved, and we agreed to it. So now the cap table is saying two equity shareholders, and I am the lone CCPS holder or say CCD holder there. That's how the cap table looks like. Now, in terms of recent developments, say companies that changed, now people are willing to have more debt on the book. There's one side of that story. Can I raise that? Because private limited companies are prohibited raising debt from third parties. You have to become a public limited company.
Third individual.
Exactly. Now, in terms of deciding whether debt is good, why do people have inclination of going towards equity or equity oriented raising rounds when debt is available? And then what are the sources? We've heard of convertible notes. What are those sources available where you're still going the equity route but still have a color of debt? So maybe you can throw some light on that.
So yeah, so there are many instruments which are talking about that it's a capital investment, but in the face of it, it's a debt. So talking about the first instrument is the compulsory convertible debenture. Again, it's a debt in the books. In the financials, it is a long-term debt, right, in the books, but it is again fully compulsory convertible into equity. So at the end, at the time of liquidation event, or say at the time of strategic sale or IPO, all of these going to be converted and will be becoming the part of the capital itself. Second one is the convertible note, right? Convertible note is again a convertible debt in the books, given by and introduced by RBI for the founders who have just incorporated the company and got the investor, say from USA or say from outside India, right? So they were struggling to get the funds because under the FEMA norms there is a provision of valuation, right? There is a provision of say pricing guidelines. So it talk about that whenever you are raising fund, whenever you are raising the international fund, you will have to provide the valuation report, or you will have to, and for the valuation report, you should have the numbers in place. Now, say I've just incorporated the company, I don't have any number, but I have the investor who is aligned with my vision or who is very confident on my idea and my team and ready to infuse the funds. Then RBI brought this instrument as a debt instrument, the convertible note, which basically says that if you are raising fund from outside India using this note, you don't need a valuation report. You don't need to provide a say financial model or all of those things. You don't need anything. You just do some basic agreement, you do some ROC compliances, and you are done.
What you're saying is very rosy. Tell us the cons as well.
So yes, the cons is that you should not be in the holding subsidiary structure. If you are, then you are
not a startup.
You are not a startup. So the two conditions are, you will need to be a DPIT registered startup. Second one is the investment amount limit. It is a 25 lakh INR per tranche per investor.
So if I'm investing, say about, am I allowed to invest 60 lakhs, so I have to do 50 or 75?
No, it should be minimum of 25 lakh per tranche per investor. It can be say 28, it can be 50, it can be 48.
Oh, so minimum has to be 25?
Minimum has to be 25. And so if you are say investing 48 lakhs, right? Your first, and these are into two tranches, correct? Then your first tranche needs to be minimum of say 25 lakhs. Then you cannot put the second tranche because it is going below this limit.
Yeah, I know we've kept a lot for our second episode in terms of dilution, but I still talk on convertible note per se, because it seems like when I'm raising a convertible note, nothing will be on my cap table. Is it true, Nitin? What's your viewpoint?
Again, not exactly. First, just wanted to add few points to convertible notes. The question is why this 25 lakh limit? Try and understand this, that startups is a new asset class nowadays. So HNIs, they want to put money into these riskier bets. So you don't want, people with, say 1 lakh, 2 lakh rupees of saving, thinking about that Zomato investors made 1000x in their investment, so I should also put my 2 lakh saving into startups. Government want to protect those things.
Right.
So the basic principle is below 25 lakhs we will not allow. So that only HNIs or people with means are investing in these startups. Second, they also understand the nature of startups. 90% startups, it's empirical evidence are there. 90% of startups are going to fail.
Maybe more.
Maybe more.
Yeah.
So that's why, at least people who can bear that kind of risk, are the only one who are investing in the startup ecosystem. That's why this limit. Now, as Akash said, in the initial phase, you need not have any kind of commitment. Why this? Because in the initial stage, neither the promoter nor the investors are aware of the true worth of the business. As I said, there is nothing on ground. That's why what you want to do, you want to avoid the question of valuation or dilution in the first instance. You want to defer this question to the next stage. So you will get the money, which can be repaid as it is, which in all probability will not go, because again, this money is going to get consumed in the business. It will pay the salaries of developers in the initial stage. So don't expect that you can actually withdraw this money. You can't, practically. So this will eventually get converted into equity based on the next round of funding. So although in the initial stage, it seems like there is no dilution, the dilution has already happened. Just that the quantum of that dilution is not fixed as of yet.
So we have again and again talked about dilution. In this specific case, people say, please show us your fully diluted cap table. Now, taking this similar example, now in this case, instead of say CCPS or CCD or convertible note with a future-oriented valuation, what do you mean by fully diluted cap table? And in our case, how will you show that cap table, right? Because right now the financials will say 100% ownership with co-founders and then a debt on the book. But what is then fully diluted?
First understand that financials, they speak a different language, the language of accounting. So we are aware of debits and credits. Not everyone is. So financials will give you slightly different picture from a compliance perspective. But from an ownership perspective, things would be different.
Yeah.
So when somebody says a fully diluted cap table or cap table on full dilution basis, these are the same terms. It simply means, what if all these people who are standing in the queue, if they were to stand with equity, how much ownership they would have? So all these convertible instruments. So I'm dividing this equity investment into two parts. One is the pure equity, which seldomly happens, and then there are equity linked instrument. So all these instruments, optionally convertible preference shares, compulsory convertible preference shares, OCDs, CCDs, convertible notes, these are all equity linked instruments, which eventually will get converted into equity. So when somebody is asking you for a full cap table based on full dilution, they're asking you to provide them a data where they can estimate what is the ownership of these convertible instrument.
Got it. So possibly that cap table will show that person as an owner, assuming that their convertible note will convert to equity at some point of time, and that is the fully diluted cap table that we're talking about. But interesting point that came out was, as a founder, maybe I can leverage convertible note as a debt if we feel we are a company that is going to be cash generating soon.
Right.
So instead of equity, we can have a convertible note and repay it and protect our equity. Is that a doable option?
It is. But the thing is, we want to be fair to the investors also. Let's say if you think that, in 6 months time, you are going to be profitable and you just needed this kind of bridge round, then investors who have a very low coupon rate on convertible notes probably will not agree to this.
Yeah. Can you just elaborate on coupon rates?
Coupon rate simply means, when you, it's a whole spectrum. At the one end of the spectrum is a pure equity. These are the people who will stand at the end of the queue. And on the second end of the spectrum is a debt instrument, a pure debt. Now, all these instruments fall within this spectrum. Some are closer to equity and some are closer to debt. Now, when you are putting money in the form of a debt, what is the difference between debt and equity needs to be understood then. Equity means that you will get paid when there are profits.
Right.
Debt means that, you will get paid irrespective of there are profits or not. So it's a kind of leverage. So when you are raising a pure debt, the coupon rate or the interest rate, as I know, it can be termed as interest rate also, would be slightly different from what you are paying on a convertible instrument, because this instrument has some coupon rate, some interest component, as well as right to convert them into equity also.
Right.
So theoretically you can always use convertible notes as a debt instrument and repay the money, but I don't think investors as such would be happy with this if the company is doing well.
I think our second episode is becoming more interesting because all this is going to come on a Excel sheet next time. It will be more interesting to see how does this dilution happens where future-oriented valuation is happening. Maybe you want to add something.
So one point to add, like you asked, right, that so the convertible note is more favorable from the founders who are looking that they can
They
build the
repay it.
profitable
Yeah,
business,
yes,
right?
absolutely.
So yes, your question is very smart, but the law has captured it.
Okay.
So it's not a right with the founder. It's
Okay.
right with the convertible note holder. It's right with the option holder, or it's right with the investor, whether they want a repayment or they want a convertible.
So founder doesn't have that option at
Yes.
all. Okay. Is that driving from the company law? Or is it driven
Yeah.
from the agreement that you do?
No, it is from the law itself.
Interesting point.
Yeah.
So moving forward, maybe we skipped out a very critical element in between, which in any case we have kept for the third episode. But now, say someone has asked a question also that what is the impact of having multiple rounds on investors? So that's a very holistic question, but I'll just cut it down. Now, in next round, somebody gave the gyan, what have you kept for your employees, which is where ESOP comes in, where now the founder has already raised money from me as an investor, but I don't see an ESOP pool yet. The incoming investor is more prolific, known to the ecosystem, coming from a matured background, and they said, where is that? What have you kept for your key employees? What is ESOP? How does it come on the cap table? And now in this specific use case where I as an investor, I'm already there, what will be the nuances that will come up?
So I'll touch base upon the ESOP, that what is ESOP, why it is required by the startup in the early stage. So ESOP is again the employee say incentive plan where the startups usually don't have their big pockets to hire the right talent, or to hire and retain the right talent. But they basically plan out the ESOPs and give the ownership. They give the fractional ownership in the long run, right?
Got it.
Who is basically aligned with the vision, who is basically aligned with the approach, or say aligned with the idea of the company, right? So ESOPs is to be introduced by the startups just for the retention purpose, plus aligning the long-term goal with the employees.
Got it.
So that they can also become the part of the growth, the growth journey of
the startup.
Yeah, of the startup. Correct. So ESOP, again, ESOP, that's what I'll say. So yeah, so the founder will need to think about that. What is the right time to basically introduce the ESOPs? Before funding, after funding, what all are the pros and cons? I think Nitin can highlight on this.
So I have a question for Nitin in any case, because I think from valuation perspective, that would be coming to you again and again. What's the right percentage for a ESOP pool? Is it number of shares? Is it driven from value of amount of money that we want to give to the employee? Or is it a certain, say, whatever part of a cap table? What is the right percentage, early stage? What should be that pool?
So I will add one more point before I answer that.
Yeah, please.
Everyone, especially the startup founders, need to understand a very simple principle that the world works on incentives. So how you align incentives of people, investors, founders will determine how things are going to turn out. The world works on incentives will also decide how to decide the co-founder equity.
Yeah.
The world, works on incentive will also decide, how much to dilute. And the same, principle will also decide how much to keep for employees. So first, what is ESOP pool is basically in this, again, the pizza has become the medium one now.
Oh yeah, we're back to the pizza. Yes.
Yeah. So now you want to have a large one, or maybe in the Indian context it would be a paratha.
Yeah, right? That's a better option. Aloo paratha. Let's use aloo paratha.
You want to have a aloo paratha with a radius of 1 meter now. Right. The question is, to make that kind of paratha, you would need people. You would need people who will arrange the potatoes.
Yeah.
Knead the dough, and then finally bake it. So those are the employees you need. You need those critical employees to stay with you, to work for you, to see the things through. If you only give them salaries, that Reliance is also giving. So why to join a startup? Even if you are matching Reliance salary, then also Reliance ka failure chance is next to zero. What is your failure chance? It's very high. So even if you're matching my compensation, you still need to pay me more, because I'm taking a risk by joining you.
Yeah.
So how do I compensate for those risks that employees is taking? And at the same time, if the equity is concentrated, then incentives of employees are not aligned with the company's future. So again, incentives. So you need to give incentives to these employees in the form of shares. So today my size is this much. Visa size, you want to increase it to next level. You need to give something. So investors generally drive this decision. They will tell you to create a ESOP pool. Means some portion of your ownership you will set aside, which will be given to different employees at different point of time. That earmarking is known as ESOP pool.
ESOP pool, yeah.
Now, how much of ownership you want to give to employees is again, it's not a static question. Just like cap table, your ESOP pool will keep on changing. It's up to you. So in the initial phase, generally people, keep 10% of the ownership for employees. When the company grows, it may even reach 20%, 25%. Right. So this is not again not a static decision that you have taken and you cannot be reversed. So you can start with 10%. Once you are growing, you may reach a 15%, 20%, 25% ownership structure in the future also.
So I'll come back to you with a problem statement, but let's go back to Akash in the sense, is it important to do certain documentary or a law compliance for this pool to be on a definitive agreement or a cap table, or is it like, oh, let's just put it on the cap table and then rest can come later on?
I think very valid question, and usually we see that the founders have already committed the ESOPs to their early employees, right? And or maybe they have agreed on a pool right in the cap table, right?
Yeah.
So that pool or say that commitment does not fulfill until you have the ESOP policy in place. You have taken the approval from your board and the shareholders. So you'll need to first have the ESOP policy rolled out. You'll need to first have the board resolution done. You will have to take the shareholders approval done. And then once all of these is done, right, then it is called the ESOP, that the company has officially adopted the ESOP policy. And then you can do whatever you want. You can give the grant, you can have the pool in the cap table, whatever. You can raise the funds because you have already set aside the pool in the ESOP policy, right? So now your investor is also safe. They are not getting diluted because of ESOPs. And we have seen a lot of, say, the investment agreement where the investor asks the penny money cap table to be included with ESOP pool, right? Because the investor does not want to get diluted because of ESOP pool.
So we'll take one question, but before that, my problem statement back to you. I had 15% almost equal convertible note with me to equity, and the founder did not tell me that 10% ESOP pool is also to be there. So I'm back to 13.5 because I was not told there's a 10% pool. Are you with me here? What should I do as a investor where I would say, oh, this was never discussed with me? I know it's a episode 3 snapshot that we're giving, but what as an investor, I don't want to go below 15. As a founder, he'll say all of us are now equal. How does it get solved? What can you just throw in some light on? What are few use cases?
This is more of a question of how the things were discussed in the earlier stage. So irrespective of how you frame it, there would certainly be certain questions which will get unanswered or which will get undiscussed in the initial stage.
Right.
So generally speaking, if ESOP pool is to be there, and it's a very, very basic thing, it should have been discussed in the earlier phase itself when the company was raising the funds, that we are going to create a ESOP pool either before your investment or after your investment. Beyond that, this is all about agreements.
Yeah.
Right. So Akash and discuss about the legal repercussions, but I think it's more of a commercial thing.
Yeah. So in our case, so I'll agree to your viewpoint. So I'll get diluted to 13.5, but I still can come as a convertible note. But on fully diluted cap table, I'll be shown as 13.5, and 10% would be a ESOP pool, and then the remaining what is it? Almost 37 something, 36, 37, or 86, 87, 76 is with the founders, right?
Right.
So let's take one question that has come up from Ayush. He says, how do liquidation preference in a cap table impact different type of shareholders during an exit event?
Yeah, I think we discussed this earlier.
Yeah.
Every agreement would have something known as liquidation preference.
Yeah.
All the seasoned investors would put a 1x. But then there are certain greedy ones, the newbies. They try to put a 2x, 3x kind of thing. which is
Can you
not going to
elaborate on
work.
what is 1x, what is 2x, what is 3x?
I mean, let's say you taking your example, you invested. I'm just simplifying the
Yeah.
numbers for competition purposes. I'm not very good with round of numbers. I mean, so let's say you invest 50 lakh rupees for 10%. That means after your fund infusion, the company's value would be 5 crores. So in 5 crores, you have invested 50 lakhs, and that's why you're holding 10% now.
Yeah.
Right. So this becomes your post-money valuation. If you remove the investment amount, you get your pre-money valuation. So in our case, the pre-money valuation becomes 4.5 crores. Right. So 4.5 pre-money, 50 lakhs comes in, it becomes.
You've already covered pre-money, post-money. I was about to come there, but maybe you can just, what is pre-money, what is post-money, and then continue with that example.
Yeah, I think I'm there only.
Yeah.
So then this 4.5 crores becomes the pre-money automatically, and this 5 crore becomes post-money. Technically,
4.5
pre-money,
plus 50, yeah.
pre-money is number which is derived. Post-money is what is discussed with the investors. So when investors say that I'm putting in, say, 1 CR for 10%, automatically your company's worth is 10 CR. 1 CR for 10%, that means
9 crore is pre-money.
9 crore is drive number, pre-money is 9 crore then. Right. Now the question is, if you can just repeat the.
What he said that how do liquidation preference in a cap table
would get,
impacted in different type of shareholders during an exit event. So when an exit is happening.
So, as I said, you don't want to be equity. You're putting your 50 lakhs in this company as, say, compulsory convertible preference shares.
Yeah.
Now, in your investment clause, in your shareholders agreement, you would mention that in case of exit or in case of liquidation, how much money you would get. Would you get your money back first? Let's say 50 lakhs.
50 lakhs.
That's 1x. So it is known as liquidation preference, or we would term it as 1x liquidation preference, or 1.5x liquidation preference would mean that you would like to have 75 lakhs first. Right. Now let's say you are putting in 1x liquidation preference, and the company gets dissolved, and all the IPRs have been sold, whatever customer contract we had, it got sold, and the company is able to realize 40 lakhs. The question is to whom this 40 lakhs will go. As I mentioned, I am sitting with 40 lakhs. I need to distribute this. So who is standing first in the queue? So you are standing first in the queue. Till the time your liquidation preference is satisfied, nothing can go to promoters, the founders.
So interesting.
So this 40 lakh rupees will automatically go to you.
But say as an investor, I am investor 1, he's investor 2. I can have a liquidation preference over him as well.
Yes.
So I get paid first, and then they get paid.
Exactly. So the thumb rule is, who invests later on will get a liquidation preference.
Okay.
So let's say if we are talking about seed, Series A, Series B. So if the company goes bust after Series B, then Series B guy would be first, standing first. I will have to satisfy their claim. Once this is satisfied, then I will go to Series A, then seed, and finally, if anything is left, we'll go to the founders.
Yeah. There was one more question around will these preference shareholders get paid back at face value? So I think we've already broadly covered this. A linked question to our ESOP discussion is, can we create ESOP pool on cap table without having any ESOP policy in place? Surabhi is asking that.
So for just to say yes, you can have the board resolution pass, and then can have a right reserve with the board that as and when required, the company can create the ESOP policy formally. But what I've seen during the diligence process in many of the companies, say as bigger level, right? So they specifically ask that if you are creating the ESOP pool, either if it is in your cap table, right, it needs to be backed by the ESOP policy and the formal route of the compliances which has been given in the Companies Act. So legally speaking, so you'll need to have the ESOP policy, you'll need to have board decision, you'll have to have the shareholder approval, and then you can place it in the cap table. But since I have talking with the founder, right, that what should be the right approach. So this is the legal answer. But yeah, there are companies who have done just by passing a board resolution and have just capped the reserve, have just reserved a right of say creating the ESOP later on after the fund is being raised.
So I'll pick up from an assurance point of view what we have seen. Some common mistakes around ESOPs where people would have given out appointment letters mentioning you will be given ESOP for 20 lakhs. That's given on 1st of October. And then next year, in about November, when they were going through a round raise, the DD happened. And of course, it came out, where is the policy? So now, as a reaction to the DD, the policy was being created. And we've even seen such cases where on appointment letter, it says you will get ESOP. 3 years have already gone by, no policy in place. Now, why should the employee suffer because you did not bring the policy in first place? So practically, things are working in this direction where founders are announcing ESOPs, giving it in appointment letters, solving it as a reaction to DD reports or audits. But the right way would be like, if you're getting a pool, it's not that much of a capital expenditure. Why not have the pool upfront itself and follow the right protocol versus reacting to certain DD findings later?
Yeah, but still, the founder are very they don't have the big pockets to basically spend in all of these things, and they basically take the shortcuts. So the solution to it, if it is being already done by a founder, right? They have given or they have as I mentioned in the offer letter that you have been granted of this much of value of ESOPs, right? So what I suggest, so let's not make a statement like that you have been granted. Let's just rephrase it. Let's just redraft it.
Yeah.
You are entitled to grant.
Yeah.
So this word entitled is giving a room to the founder who have basically given a grant of, or say promised a grant of 2 years back or 3 years back, right? But implementing or say bringing the policy in the company right now. So it gives a room, and it basically dilutes the question from the employee that you have promised me, or you have mentioned in a document which you have given to me as an offer letter or as a employment agreement, where you have seen or where you have mentioned that you are being granted. So change this line, you are being entitled for a grant. So
interesting.
So yeah, this can be.
So we'll just extend by 10 minutes. I think what we said was done, but we have a couple of questions that have come in, and there are people from Lucknow, Jaipur. So there are folks pan India. Good to see that. And you guys, if you have any questions, we are happy to take that as well. So let's go and try and finish on a practical aspect. We've seen investors coming on cap table where they have convertible notes or CCDs or CCPS, but then they say 10 equity share दे दो मेरे को पहले, उसके बाद बात करेंगे. So how is it and why is it that in a shareholders agreement we see CCPS holders stressing कि नहीं 10 तो equity चाहिए? Why does that happen?
So likely I mentioned, right, that giving the preference, one of the reason for the founder is that they don't dilute in the voting rights, right? But I also mentioned in my previous thing that they are investors who are focused and who may ask you to say the combination of both, say nominal equity and whatever is been rest is by way of preference shares. So the equity is being asked by the investor to have the voting control, or say to have the rights on all the shareholders matter where the founder have the rights. So in the preference, so since these are not the common stocks, they generally don't have all the rights of the common stock, right? So usually investor asks for those 1 equity share or say the 10 equity shares, so that they can get the notification of all the shareholders matter which the company is being taken in place. So yeah. So
just shifting a little bit on the practical side, I know I have asked this question multiple times from you, but I'll ask on this platform also. When you're doing valuations, and we've seen these crazy valuations come up, right? Fresh company, $1 million valuation, or nil revenue and such a high valuation. Of course, they are future driven. When you are kind of doing that valuation exercise, what goes through your mind? Because ultimately, I would say registered valuer's mind who's issuing that report. That outside in the market, people are questioning कि भाई क्या हो रहा है ये? And but as a professional, you are asked to certify or say give an opinion that you also feel नहीं report ये evaluation. So what goes through your mind when such kind of valuations happen, and how do you foresee those use cases?
I mean, I think I will answer the same way I answered the last time. The thing is, one, nobody knows the future. In 2008, nobody would have thought about, Flipkart becoming a multi-billion-dollar business. Same goes with Nykaa or any listed player you can, talk about. And there are unlisted companies also. There are companies like TikTok. To us, it's just a platform, but then a company with $400 billion of valuation is, I mean, it's
Yeah.
something to think about, right?
Absolutely.
Now, when people say, I mean, this question has been asked to me several times that how do you justify these valuations? The answer is the failure of ventures, failure of startup is a feature.
Yeah.
When you think of it as a feature, then I mean things will start making sense. That you put your faith on something, some idea, some team, some people, some markets. It may or may not turn your way. But that's the whole thing. I mean, 90% would fail, but then 10% of those will become, huge bets, those moonshots, as they call them. So that's one aspect. Second is there is a set of investors who I think are, I mean, they're sophisticated enough, educated enough to understand the risk associated with these startups. And on the other hand, there is a startup founder who has pitched his idea, the market potential, etc., to these investors. Now, these are two rational adult people deciding on certain value. Then who I am to question that? That's a question. I mean, so I don't question their judgment. I know I believe in free market and the individual wills to act. So if two people are deciding on certain value, that's the value I'm going to drive. Right. As I said in the initial phase, it's all negotiation between founders and the investors. Later on, it becomes data-driven, operational matrices driven.
So we've always used the word free will, and I always go in the philosophical direction. Oh, we can debate on free will, but let's just park that.
Yeah, it's a different tangent altogether.
Yeah,
we will be sitting here till tomorrow.
Yeah, maybe eternity, maybe next life. We never. There's no answer.
Yeah. So if I believe in free will, I will simply walk off. But
yeah. So we have got some interesting questions. It's repetition, but let's just pick it. Ashwin is asking, what is the impact of convertible notes in cap table? I think we've covered it, but maybe just for the sake of answering, you can.
So
question is, what is the impact of convertible note on cap table?
Impact on
convertible
impact of the convertible
so
note.
Possibly, I think what they're answering, but we've already answered that it will never come on the cap table per se on the financials.
Correct.
But in terms of fully dilution, you will always have to use that valuation methodologies, assume that they will get converted, and that will come on the cap table that you will see.
That's correct.
Next question is, can you throw some light on vesting schedules, which is episode 3, which is coming already? And when a founder does not perform his role, how to deal with such a situation?
So again, the answer has been here given that if the founder is not performing, right, why don't you have the co-founder in, say, the agreement in place? So if you would be having the co-founder agreement in place, right, then you would have got already your answer, that you have the rights, you have the provision, which is being absolutely clear, right? If say X co-founder is not performing, then what is to be done? So the co-founder agreement is what the founder should have in place.
Yeah. So I always say that best of the co-founders agreement are those that are never used. Because when you are creating it, you are kind of creating a layer of never getting into those kind of disputes. Because at the back of the mind, you get back to a situation where you agreed on such certain terms and conditions.
It shows trust deficiency also. And especially in the initial phase, it's very difficult to define the rules.
Yeah.
Right. I mean, company itself is evolving. A founder, co-founder would wear different hats at different point of time. In the initial phase, even CTO would be doing the HR work. The marketing guy would be developing the product. You don't know who will suit the best to different, verticals of business.
Absolutely.
So, co-founders agreement, it may work, but as you said, it's difficult to define the rules.
So we'll come to vesting schedule. I think we'll park that for later because we already have a episode planned for it. Another question, which is I think we'll cover in the next episode, they're asking about broad-based adjustment in anti-dilution. I think which is a high-level technical. Maybe you can just touch base on it, but of course we can pick it up. We can park it for later if you like, but if you think you can summarize it in one or two sentences.
We'll try. So the idea is, when we said that investors put their money not in equity but in CCPS or CCDs, one reason was the liquidation preference. Another one was, equity is the final destination, not that kind of final destination. The movie one.
Yeah.
These are the last people. There is nothing beyond equity.
But for 95% of startups, it apparently ends up as a final destination.
Right. Yeah. That's a separate discussion.
Yeah.
The thing is, when you are putting money in CCPS, you are not fixing the ratio as such upfront, or even if you are fixing, there is a possibility of changing that.
Yeah.
So let's say you fix your conversion ratio that every CCPS will become 1 equity in future. So you're fixing that, but there is still a scope to change that. When those changes would happen, let's say in our example, you gave me 50 lakh rupees for 10%, right? So that means
13.5.
No, I'm going with a simpler one. So 50 lakhs for 10% was easier one. So 5 crore was your post-money valuation, company's post-money valuation. The thing is, let's say after 6 months, the things are not working too well. And I'm again going to the market, and this time around, somebody else is putting 30 lakhs. I'm desperate. I will take the 30 lakhs, and he's still asking me 10%. I will have to dilute. So now this guy, the new guy, will get 10% of the company by just paying 30 lakhs. Now the first one, that is you would be, you would be livid. You would say, okay, I put in 50 lakhs for the same 10%. Why I'm getting a bad treatment? I came earlier. I took more risk than this guy, and he's still better off than me.
Yeah.
So in that case, we will try and compensate you by changing your conversion ratio. So instead of 1 equity share, I will give you, for every CCPS, I will give you, say, 1.25 equity shares. So your stake in the company would slightly increase. I'm not saying I will compensate you 100%, but slightly. So that is the reason why these convertible instruments are used in funding. One, liquidation preference, and second, as I said, down round hedging or anti-dilution.
So for people watching, I think that's a good benchmark you've set up for the next episode, where we are going to talk about term sheets, what are the rights, what are the different anti-dilution, liquidation preference, and how does that actually practically work. We'll kind of discuss that over an Excel sheet and run through examples. And just go back, can we go back to the previous slide, which was having Didier? So I was going through this, and I realized that what I said, after a Series A, founders have more than 50%. So this looks like a typically good cap table that can be kept as a benchmark. So yeah, you can go back to the next. So we'll try and wrap up with one last question, and Akash, you have to answer it very diligently. And this is coming from a practical use case. So in the similar situation where now you have 2 co-founders, and there is investment that has come in, there is ESOP pool. Now there's a third founder that wants to come in, which is a typical use case which we keep on getting here. अब तो 25 million valuation हो गई, अब कैसे लेके आए?
Right.
ESOP पे ले आते हैं, फिर लेकिन ये तो founder है, co-founder level पे आ रहा है, अब you want to give him importance. I know there could not be a very straightforward answer to it, but what kind of a suggestion you would like to give to the ecosystem? Are there options available? How should they be solved? Should they be contacted to you? Or is there any standard means, or you want to set up a standard protocol that whenever certain co-founder shuffling is happening, let's just use this as a base?
So yeah, I'm more than happy to assist if anyone wants to reach out to me. Yeah. So to answer this is, yes, there are options where the company has raised some funds and they have diluted, and then they are bringing the co-founder in place. So there are option, and one is the option of the co-founder equity transfer, right?
Yeah.
If the equity transfer is been happening, so that need not to be done, right? At the same value at which the company has raised the funds. Again, there are valuation norms, there are valuation to be
We'll go to Nitin for that. Yes, definitely.
So yes, the existing founders can transfer their own shares to the new founders at some cheaper value,
which can be different from
which can
primary
be different,
allotment.
correct. Which can be different from. Plus, there are some other routes as well. Like you mentioned, the option route is there, the ESOP routes, right? The sweat equity route is there. So yeah, there are routes.
So just to finish off today's episode, one last question to you, continuing from this, would be: is valuation also purpose driven? So, like in this use case, we said today there's a primary allotment that's happening for a round that we are raising, and 2 months down the line there is a secondary that's happening. So can valuations be purpose driven, and can they be different?
Absolutely. Absolutely. First point of differentiation would be the valuation for compliance purposes are totally different from valuation from a commercial angle.
Absolutely.
Right. So commercial transactions happen at a different valuation, and when you have to justify those transactions to the government, this is basically compliance valuations. And as you rightly pointed out, every purpose would have different compliance, and the methodology would change.
Yeah. So there's a possibility there.
Yeah.
Perfect. So I think we'll wrap up here. It's been quite a 1 hour journey of lot of cap table have already taken shape, but we'll develop this in our next 2 episodes where we'll talk about dilutions, preferences, more rounds, more investors, and what are the practical challenges that are coming up with the founders or for service providers or for investors, and how are they getting solved for. So thank you for joining today. Happy Diwali, and the next episode will be aired post Diwali. Thank you.
Thank you.